I will start the first part by discussing the measurement of provision. So, what exactly is meant by provision? A provision is an obligation that is uncontained in amount or time, but is likely to occur. Then, how does a company determine the amount of provision that must be recorded in the financial statement? Well, according to IFRS, the amount of provision recorded must be the best estimate of the cost required to complete the obligation completely, and it's calculated based on the condition when the financial statements are prepared. This means if a company has an obligation that is likely to occur, even though the amount is uncertain, the company must still calculate how much it will cost if the obligation has to be paid now. To arrive at realistic estimate, companies don't choose guys randomly. Instead, management usually considers several factors, such as reviewing experience from similar past cases, consulting with experts, gathering relevant information. In addition, the company uses professional judgment based on available data and information. To make it easier to understand, I will explain three examples from large company. First is Toyota warranty. Toyota analyzed data from previous car sales. They estimate that 80% of cars would not claim warranty, 12% would likely claim at high cost, and 8% would claim at low cost. From this data, Toyota will calculate the average estimate warranty cost based on the changes of each possibility. This is called expected value. And second example is Carrefour refund. Carrefour sell various goods at different prices. If there is a return of good by customer, the value can vary because the possibility at each point in the return range is considered the same. Carrefour can use the midpoint of the range as the basis for measuring provision. And the last example is Novartis lawsuit. Large companies like Novartis often face lawsuit. If the companies know that they are likely to lose a particular case, then they will use the most likely outcome as an estimate of the cost that must be prepared. In addition to calculating the estimate cost, the company must also consider two important things. First is time value of money. If the provision amount is quite large and the payment is still a long way off, then the company must calculate the time value of money, or in the other word, the present value of the money that will be paid in the future. And second is future event. If there are things in the future that could affect the provision amount, such as changes in the law or market condition, then that must also be taken into account in the cost estimate. Now that you know how to measure provision, now I want to discuss the type of provision that are often found in companies. Provision can arise from variety of situations, such as first is lawsuit, such as if a company is being sued and likely to lose, and second is product warranty, such as company promise to repair damaged goods, and the third is consideration payable. Incentives such as discount or cashback to customers who have made a commitment need to be reconsidered as an obligation. And fourth is environmental obligations such as waste cleanup costs. And next is onerous contract, namely contract that must be executed even if a loss. And the last is restructuring, such as severance pay due to may layoff. According to IFRS, companies are required to disclose this provision in detail in the notes to the financial statement. However, general risks like war, natural disaster, or economic recession are not required to be recorded as provision because they are too unpredictable and non-specific. Next, litigation provision. In legal cases, company must consider first, when did the event that caused the claim occur? Second, is it probable that the outcome will be unfavorable? Third, can the potential loss be reasonably estimated? If the answer to all questions is yes, the company must recognize the obligation as a provision. Sometimes, even if a lawsuit has not yet been filed, If it's highly probable and the loss can be reasonably estimated, the company should still record the provision. Litigation provision refer to liability that a company must consider when facing legal matter. Even if a lawsuit or a claim has not been officially filed, in such cases, the company needs to evaluate whether there is high likelihood that a lawsuit will be filed or a claim will be asserted. Additionally, the company must assess whether the outcome of such a lawsuit is likely to be unfavorable. If the company determines that both the filing of a claim and the risk of loss are probable, and the potential loss can be reasonably estimated, and the event causing the claim occurred on before the date of the financial statement, then the company is required to recognize the potential loss in its financial statement as a liability or expense. In other words, even if no official lawsuit has been filed, if the risk and potential loss from accident can be reasonably predicted and measured, the company must record a provision to cover that possible loss. For example, if a company called Scorsese Inc. is involved in a lawsuit of December 31, 2019, and it is likely that the company will lose that case, will the estimated loss amounting 900,000 that the company need to record this potential loss in financial statement. The journal entry would show a debit to lawsuit loss and credit to lawsuit liability for 900,000. This reflects the company recognition of the expected loss as provision. However, if the outcome of the lawsuit is not likely to be unfavorable, the company does not need to make any journal entry. This is because the criteria of recognition provision have not been met. And next is warranty provision. A warranty is a promise from the seller to repair or replace a defective product. If the company knows that some of products sold will definitely be claimed under warranty, and they can calculate how much it will cost, then the company should record the provision as a warranty expense and warranty liability. Thank you for your attention. Now I will hand it to over my friend who will present the next topic.
Now I will explain more about warranty provisions. So, companies typically offer one of two types of warranties to customers. One of these is the assurance type warranty, which is a quality guarantee that the product or service is free from defects at the point of sale. This type of warranty is considered a standard obligation and is part of the sale transaction. There are two key characteristics of an assurance type warranty. The first, warranty costs should be recognized as expenses in the same period when the goods are sold or services are performed. In other words, the estimated warranty cost must be recorded at the point of sale, not when the customer makes a claim. As an example, a company sells a laptop in January for $1,000 and it estimates $50 warranty cost. So the company will immediately record $50 as warranty expenses in January, the same time the laptop is sold. And second, the company must also record a warranty liability because it is expected to incur future costs related to fulfilling the warranty obligations. As an example from the same laptop sale before, the company also records $50 as a liability, an obligation to cover future repair costs if needed. And this is a case study of Denson Machinery Company. They began production of a new machine in July 2019 and sells 100 of these machines for $5,000 cash by year end. Each machine is under warranty for 1 year. Denson estimates, based on past experience with similar machines, that the warranty cost will average $200 per unit. Further, as a result of parts replacement and services performed in compliance with machinery warranties, it incurs $4,000 in warranty cost in 2019 and $16,000 in 2020. So the questions: what are the journal entries for the sale and the related warranty costs for 2019 and 2020? And this is the first transaction records the sale of machines by Denson Machinery Company during the period from July to December 2019. The company sold 100 machines at the price of $5,000 each, resulting in a total cash receipt of $500,000. In this transaction, the company debits the cash account for $500,000 to reflect the inflow of cash from customers. This increases the company's asset. At the same time, the company credits the sales revenue account for $500,000 to recognize the income generated from the sale of the machines. This entry shows that the company has completed a revenue-generating activity and has earned income. Since the machines are sold with an assurance-type warranty, the company is expected to cover the cost of any defects or repairs related to the machine sold. For the second transactions after the sale of the machines, the company provided repair services or replaced defective parts under the assurance-type warranty. These actions resulted in actual costs amounting to $4,000. In these transactions, the company debits the warranty expense account for $4,000. This reflects the use of company resources such as labor, parts, or services to fulfill the warranty obligations. The debit to warranty expense represents the actual cost incurred to repair or service the products sold. And the credit side of the entry includes cash, inventory, or accrued payroll, depending on the nature of the warranty service provided. This journal entry recognizes the reduction in resources used to fulfill the warranty obligation and ensures that the actual warranty costs are properly reflected in the financial statements. This entry follows from the initial estimation and accrual of the warranty obligation made at the time of sale. This transaction is an adjusting entry made at the end of the accounting period on December 31, 2019 to estimate the remaining warranty costs that are expected to be incurred in the future, specifically in 2020. The company estimates that the total warranty cost related to 2019 machinery sales is $20,000. Out of the amount, $4,000 has already been incurred and recorded as shown in transaction 2 before, and therefore the remaining $16,000 must be recognized as a liability for expected future warranty claims. So the company debits warranty expense for $60,000 to record the expense that matches with the 2019 sales. This ensures that financial statements accurately reflect all expenses related to the revenue earned in that year. And at the same time, the company credits warranty liability for $16,000 to recognize the company's obligation to cover future warranty claims. This adjusting entry ensures that the statement of financial positions at year-end reports a warranty liability of $16,000 and the income statement for 2019 reflects the full warranty expense of $20,000 related to the $500,000 in sales. And for this transaction records the actual warranty costs that were incurred during 2020 in relation to the machinery sold in 2019. As the company fulfills its warranty obligations, actual costs are incurred. This cost total $16,000, matching the previously recorded warranty liability. To account for these costs, the company debits the warranty liability account for $16,000. This reduces the liability on the balance sheet as the obligation is being settled. On the credit side, the company reduces the resources used to fulfill the warranty, which may include cash, inventory, or accrued payroll. By the end of 2020, this transaction eliminates the previously recorded warranty liability. As a result, no warranty liability remains in the financial statements for the 2019 machinery sales. This closes the warranty accounting cycle for those sales. And next is a service type warranty. A service type warranty is a separately priced extended warranty offered by companies beyond the standard assurance type warranty. This warranty covers additional services or periods that go beyond the regular manufacturer's obligations. This includes, as for the first, usually recorded in an unearned warranty revenue account. So when a customer purchases a service type warranty, the company receives payment in advance for services that will be provided in the future. Since the company has not yet delivered any services at the time of cash receipt, the revenue is not immediately recognized. Instead, it is recorded as an unearned warranty revenue, which is classified as a liability account. This account reflects the company's obligation to provide warranty services in the future. It represents a liability because the company owes services to the customer until the warranty period ends. And the second is recognized revenue on a straight line basis over the period the service type warranty is in effect. Revenue from a service type warranty is not recognized at the time of cash receipt, but rather recognized gradually over the warranty period using the straight line method. This means the total warranty revenue is evenly allocated across the duration of the warranty period, depending on how long the coverage lasts. This ensures that revenue recognition aligns with the company's actual performance in fulfilling the warranty obligation over time. And this is for the case summary. On January 2, 2019, Hamlin Auto sold an automobile for €30,000. It includes an assurance type warranty with an estimate cost of €700, a service type warranty sold separately for €900, covering an additional 3 years of 36,000 miles. Hamlin incurred costs of €500 in 2019 and €200 in 2020 related to the assurance type warranty. Revenue for the service type warranty is recognized on a straight line basis. So, what entries should Hamlin make in 2019 and 2020? And so, for the journal entry, Hamlin Auto records the sales of an automobile for €30,000 and a service type warranty for an additional €900, resulting in a total cash inflow of €30,900. And the full amount received is debited to the cash account, reflecting the increase in cash from the customer. The €30,000 related to the automobile is recognized as sales revenue because the performance obligation, the delivery of the vehicle, has been fulfilled at the point of sale. However, the €900 received for the service type warranty is not immediately recognized as revenue. Instead, it is credited to the unearned warranty revenue account, which is a liability. This reflects Hamlin's obligations to provide warranty services over a future period of 3 years or 36,000 miles, whichever comes first. The revenue from this warranty will be recognized gradually using the straight line method over the life of the warranty period. This treatment aligns with the revenue recognition principle, which requires companies to recognize revenue when it is earned and not simply when cash is received.
Okay, here I am. Putra will continue the explanation from my friend. In step 2, a recording is done to record the warranty costs incurred in 2019. In that year, Hamlin Auto experienced warranty costs of €500. This cost comes from the assurance type warranty, which is the standard warranty given when the car is sold. And the journal is the warranty expense account is debited by €500, and the cash or inventory or accrued payroll account is credited by 500 euros. The warranty expense account shows that the company bears the burden of repairing damage or losses according to the warranty given, while the cash, inventory, or accrued payroll account is used depending on the form of payment for warranty costs, whether the company pays cash, uses spare parts, or pays for labor. Next, the third step is recording the estimated remaining warranty cost. From the question or the case, it is known that the total estimated cost for the assurance type warranty is 700 euro. Because 500 euro has occurred in 2019, the remaining, which is 200 euro, must be recorded as a liability at the end of the year. So the journal is warranty expense is debited and warranty liability is credited with a nominal amount of 200 euros in each account. Although it has not occurred, Hamlin estimates that it will still incur warranty costs of 200 euro in the following years. Therefore, this cost is still recognized as an expense in 2019 and recorded as a liability that shows a burden to customers in the future. And this is the next journal entry, namely recording revenue from service type warranty in 2022. As we know from the question, the service type warranty was purchased by the customer for 900 euro and is valid for 3 years. Because revenue is recognized on a straight line basis, each year Hamlin recognizes 300 euro as revenue. So the journal is unearned warranty revenue in debit and warranty revenue in credit for 300 euros. Why? Because at the end of 2022, the service type warranty comes into effect after the assurance warranty ends at the end of 2021. So 2022 is the first year of revenue recognition of 300 euros. As you can see here, the explanation below says that warranty costs under the service type warranty will be expensed as incurred in 2022 until 2024. So 2022 is the first year of the service type warranty is valid. Next, I will explain about consideration payable. In sales strategy, companies often provide various forms of rewards to customers as part of a sales agreement or what we call it as revenue arrangement. This form of reward is called consideration payable. Companies often make payments, provide consideration to their customers as part of a revenue arrangement. Companies often pay or give something to customers as part of marketing strategy to increase sales. This reward can be in the form of goods, cash, or additional discounts, and is usually promised after the customer buys the product. Companies offer premiums such as additional items for certain purchases. For example, if you buy 5 cans of milk, you will get a beautiful bowl. And then coupon offers, which is discount coupons for the next purchase, and rebates such as cashbacks to stimulate sales. In accounting, it is important to record the cost of this reward in the same period as the sale. So even though the gift, coupon, or rebate has not been given, the company must estimate how much the cost might be and record it as an expense and provision when the sales occurs. This is in accordance with the matching principle, namely matching income and expenses in the same period. And here we are presented with a case example of consideration payable. There is a company named Fluffy Cake Mix. It sells boxes of cake mix for 3 euro per box. In addition, Fluffy Cake Mix offers its customers a large durable mixing bowl in exchange for 1 euro and 10 box tops. The mixing bowl costs Fluffy Cake Mix 2 euro, and the company estimates that customers will redeem 60% of the box tops. The premium offer began in June 2019, And during 2019, Fluffy Cake Mix purchased 20,000 mixing bowls at €2, sold 300,000 boxes of cake mix for €3 per box, and redeemed 60,000 box tops. And the question is, what entries should Fluffy Cake Mix record in 2019? And here is the answer to the question on the previous slide. The first step is to record purchase of 20,000 mixing bowls at €2 per bowl in 2019. These mixing bowls will later be used as gifts or premiums for customers. Since each bowl is purchased at €2, the total will be €40,000. And the journal entry is premium inventory on the debit side and the cash account on the credit side of €40,000. In the second step, Fluffy Cake Mix records the sales of the 300,000 boxes of cake mix sold during the year. Each box was sold for €3, so the total cash receipts were 300,000 times €3, which is equals €900,000. And since the sale was for cash, the cash account is debited for €900,000, and the sales revenue account is credited for the same amount to reflect the revenue earned. At this stage, the company records a gift exchange transaction by customers, namely the redemption of 60,000 box tops. To get one bowl, customers must hand over 10 box tops and pay €1. So, 60,000 box tops can be exchanged for 6,000 bowls. That is, 6,000 customers make an exchange and each pays €1. So the total cash receipt is €6,000. Because the company must hand over 6,000 bowls and each bowl costs €2, the total value of goods removed from inventory is €12,000. However, because customers pay €6,000, the company only bears the rest, which is €6,000 as premium expense. In conclusion, in the debit section, there are cash and premium expense accounts with a nominal value of €6,000 each. And then in the credit section, there is an inventory of premiums account of €12,000.
So the next step is to calculate the premium liability that has not yet occurred in 2019. The total estimated redemption is 60% of the total box tops, or 300,000 from the total box tops sold in 2019, multiplied by 60%. That makes the total estimated that would be redeemed is 180,000. From here, we need to calculate the cost of estimated redemption. As we know that the customer would get the mixing bowls or the premiums every 10 top box, so we need to divide it 180,000 box tops by 10 times in parentheses €2 minus €1. €2 is the cost of the mixing bowls we buy and €1 is the exchange. That makes the cost estimated is 18,000. The redemption that has occurred in 2019 is 6,000, makes the redemption that has not occurred is 12,000, derived from the total redemption, which is 18,000, minus 6,000 by the redemption to date. So we need to record the 12,000 as the liability. The adjusting entry to record additional premium expense and the estimated premium liability at December 31, 2019 is as follows. As we know that we have already calculated the premium liability before, so to record it, on the debit side we got premium expense, and on the credit side we got premium liability with total amount of 12,000. The adjusting entry to record additional premium expense and the estimated premium liability at December 31, 2019 is as follows. As we know that we have already calculated the premium liability before, so to record it, On the debit side, we got premium expense, and on the credit side, we got premium liability with total amount of 12,000. The December 31, 2019 Statement of Financial Position reports premium inventory of 28,000, which is from 40,000. It is the inventory we buy from the previous slide, minus 12,000, which is €2. The price of each of the premium inventory times 6,000, the redemption that has occurred as a current assets, and premium liability of 12,000 that we have calculated before as a current liability. The 2019 income statement reports 18,000, which is from 6,000 plus 12,000. 6,000 is the redemption that has occurred plus 12,000, the redemption that has not occurred yet, premium expense as a selling expense. The next material is about environmental provision. A company is required to recognize an environmental liability when two conditions are met. First, there is an existing legal obligations related to the retirement or dismantling of a long-lived assets. And the second, the company can reasonably estimate the amount of the liability involved. This ensures that the costs associated with environmental responsibilities are properly accounted for in the company's financial statements. Obligating events. A company must recognize a liability when it has a legal obligations to perform certain actions related to environmental responsibilities. These obligations arise from specific events or requirements imposed by law or regulations. Common examples include: first, decommissioning nuclear facilities; 2. Dismantling, restoring, and reclamation of oil and gas properties; 4. Closure, reclamations, and removal costs of mining facilities; and the last is closure and post-closure costs of landfills. Recognizing these liabilities ensures that companies account for future environmental costs in their financial statements, reflecting their true obligations. The next topic is about measurement and recognition of environmental liabilities. A company measures an environmental liability by estimating the best possible cost of future cleanup or retirement activities. When recording this liability, the company adds the estimated cost to the carrying amount of the related long-lived asset, such as machinery or a facility, and records a liability for the same amount on the balance sheet. This process ensures that both the asset's value and the future obligations are accurately reflected in the financial statements. So in here, we have case study of Wildcat Oil Company. Wildcat Oil Company built an oil platform that must be dismantled and removed after 5 years. The estimated cost for this is $1 million. Using a 10% discount rate, the company calculates the present value or fair value of this future cost to be $620,920. On January 1st, 2019, Wildcat records this amount as an environmental liability, reflecting the obligation to dismantle the platform while also increasing the asset's carrying value by the same amount. Wildcat records this liability on January 1st, 2019 as follows. On the debit side is drilling platform, and on the credit side is environmental liability with the total amount of $620,920. During the useful life of the oil platform, Wildcat Oil Company spreads the retirement costs evenly over 5 years using the straight line method. Each year from 2019 to 2023, Wildcat records depreciation expense of $124,184, which is from 620,920 divided by 5 as a debit and accumulated accumulated depreciation on the planned assets as a credit for the same amount. This process gradually reduces the asset's book value and recognizes the expense related to the asset's retirement over time. Because the environmental liability represents a future cost, Wildcat Oil Company must recognize interest expense each year as the liability grows over time due to the discounting. On December 31st, 2019, Wildcat records on debit side is interest expense of $62,092 calculated as $620,920 times 10%, which is the discount rate, and on the credit side is environmental.
So for this one is Wildcat Oil contracts with Rig Reclaimers Inc. to dismantle an oil platform for $995,000, even though the previously estimated environmental liability was $1 million. So here's what happened. Wildcat previously estimated that it would be cost $1 million to dismantle an offshore oil platform. This estimate had already been recorded as a liability, but when they actually went to settle it, the real cost was only $995,000. So here's what they record. So on January 10, 2024, they put 1 million on environmental liability, and for the credit is going on settlement of environmental liability for 5,000 and cash for $995,000. So basically they reduced the environmental liability for $1 million and record a gain of $5,000 and paying cash with $995. And now we're going to talk about one rules contract provisions. The unavoidable cost of meeting the obligations exceed the economic benefit expected to be received. So let's break this down. An owner's contract is basically a bad deal you can't escape. Even if you no longer benefit from the contract, you are still legally bound to fulfill it or pay a penalty to exit. Accounting rule says that when a contract becomes one ruse, you must recognize a loss and a liability for the least costly way to exit. Either first, finish the contract and take the loss, or second, pay the penalty to terminate it early. This ensures the company doesn't hide future losses just because they haven't happened yet. You record the loss now. Now for the illustration, Smart Sports decides to move into a new facility, but the old lease continues for 3 years and can't be cancelled or sublet. Estimated unavoidable cost is 200,000 euros. So in this example, Smart has a big problem. They are stuck paying rent for 3 more years on a building they no longer use, and there's no way out. So under the IFRS, they must record a loss on lease contract and set up lease contract liability. This way, the loss show up in the financials now, not 3 years from now. So providing a clearer picture to investors and stakeholders about the company's obligation. And now in the same case, now Smart can cancel the lease by paying a 175,000 euro penalty, which is cheaper than staying. So now they have a choice to pay 200,000 euros in future rent payments or 175,000 euros as a one-time penalty. Since the penalty is cheaper, they should recognize only 175,000 euros as the liability. This is known as the least net cost of exiting. By recording the lower cost, Smart avoids overstating their losses, and the financials reflect what the company will actually spend. And now we are going to talk about restructuring provisions. So restructuring is a planned program that significantly changes how a company operates or what it does. Think of restructuring like a company hitting reset. Maybe it's shutting down a business line, laying off staff, or relocating operations. But the company can just make fog plans and record liabilities. To record a restructuring provision, IFRS requires first a detailed formal plan and not just an idea, and the second is communication of that plan to those affected so there's a valid expectation that it will be carried out. Only then can the company record the expected costs as liabilities. IFRS provides specific guidance related to certain costs and losses that should be excluded from the restructuring provision. As you can see here, they are divided into two. The one is cost included, like direct and incremental, and the one is cost excluded. For the cost included, uh, it's including employee termination costs related directly to the restructuring, and also contract termination costs such as lease termination penalties and one-verse contract provisions. And for the costs included, it contains investment in new systems, lower utilizations of facilities, cost of training or relocating staff, cost of moving assets or operations, administration or marketing costs, allocations of corporate overhead, and expected future operating costs or expected operating losses unless they related to one risk contract. And now is self-insurance. Self-insurance is not insurance but risk assumption. There is little theoretical justification for the establishment of a liability based on a hypothetical charge to insurance expense. Conditions for occurrence stated in IFRS are not satisfied prior to occurrence of the event. So, if a company chooses not to buy insurance and instead sets aside money in case something bad happens, that doesn't count as a liability under IFRS. Why? Because no past event has occurred yet, there's no present obligation, and you can really reliably estimate what hasn't happened. So, unless there's been an actual loss, companies can create an artificial charge or provision just to look cautious. The prevents manipulations of profits or smoothing of earnings.
So now we move to disclosure related to provisions. A company must provide a reconciliation of its beginning to ending balance for each major class of provisions, identifying what caused the change during the period. In addition, provision must be described and the expected timing of any outflows disclosed. Disclosure about uncertainties related to expected outflows, as well as expected reimbursement should be provided. Contingent liabilities. Contingent liabilities are not recognized in the financial statements because they are a possible obligation but not yet confirmed, a present obligation for which it is not probable that payment will be made, or a present obligation for which a reliable estimate of the obligation cannot be made. And here, the illustration of contingent liabilities that presents the general guidelines for the accounting and reporting of contingent liabilities. Here, the outcome is virtually certain, probable more likely than not, possible but not probable, and remote. For the probability, for virtually certain, at least 90%, probable 51 until 89% probable, possible but not probable 5 until 50%, and remote less than 5%. For the accounting treatment of virtually certain, report as liability, probable is report as liability, possible but not probable is disclosure required, and remote no disclosure required. In practice, the percentage for virtually certain and remote may deviate from those presented here. Contingent assets. A contingent asset is a possible asset that arises from the past events and whose existence will be confirmed by the occurrence or non-occurrences of uncertain future events not wholly within the control of the company. Typical contingent assets are possible receipts of monies from gifts, donations, bonuses, possible refunds from the government in tax disputes, and pending court cases with a probable favorable outcome. Contingent assets are not recognized on the statement of financial position. Here are the contingent assets. The general rule related to contingent assets are presented in this illustration. The illustration is same, but I'm gonna give the conclusion that contingent assets are disclosed when an inflow of economic benefits is considered more likely than not to occur. That is mean greater than 50%. Presentation of current liabilities that is usually reported at their fully maturity value, and differences between present value and the maturity value is considered immaterial. Here are the presentation of current liabilities from Wilmar International Limited. I'm not gonna spell all the number, but I'm gonna spell the account, that is inventories, trade receivables, other financial receivables, other non-financial assets, derivative financial instruments, financial assets holding for trading, other bank deposits, cash and bank's balance for current assets. And for current liabilities, have account, trade payables, other financial payables, other non-financial liabilities, derivative financial instruments, loans and borrowings, and last is tax payable. Here are the liquidity regarding a liability is the expected time to elapse before its payment. Two ratios to help assess liquidity. Here, the illustration is compute these two ratios using the information for Wilmar International Limited in the illustration from before. The formula is current ratio is current assets dispute current liabilities. Current assets divide current liabilities. For the asset test ratio is cash plus short-term investments plus net receivables divide current liabilities.
And maybe I was made to be lonely, 'cause I'm standing here with open arms. Oh, I just want somebody to